Most retirees have no idea they're being robbed in broad daylight. Are you one of them? I'm going to tell you something that'll make your blood boil. Something the financial industry prays you never figure out. Something so simple, so obvious, that when you see it, you'll wonder how you missed it for so long. Your retirement fund is being drained. Not by market crashes, not by bad luck, by the very people you're paying to protect it. And they're doing it legally. I'm Jack Bogle. I created the first index fund in 1975. Wall Street laughed at me. They called it un-American. They said I was crazy. You want to know why they laughed? Because I was about to expose their scam. Here's the number that should terrify you. The average American loses over $50,000 in retirement savings to fees alone. $50,000. That's not a typo. That's not the worst case scenario. That's average. But here's what really gets me. Most people don't even know it's happening. You check your statement, you see your balance. Maybe it went up, maybe it went down. You think, well, that's the market. No, that's not just the market. That's the silent wealth killer. And it's feeding off your retirement every single day. Let me show you how the scam works. You walk into a financial advisor's office, nice suit, fancy diploma on the wall. He tells you he's going to beat the market for you. He's going to actively manage your money. He's got proprietary strategies and insider knowledge. Sounds good, right? Here's what he doesn't tell you. He's going to charge you for that service. And the fund he puts you in, that's going to charge you too. And the trades he makes, those cost money. And the commissions, more money. And the administrative fees, more money still. All told, you're probably paying 2% per year, maybe more. 2%, you think? That's nothing. That's what they want you to think. Let me show you what 2% really means. Imagine you have $100,000 in your retirement account. You're 45 years old. You've got 20 years until retirement. The market returns 7% per year. That's the historical average. With a 2% fee, your account grows to $265,330 by age 65. Not bad, right? Now watch this. If you paid just 0.05% in fees, the cost of a simple index fund, that same $100,000 grows to $386,968. The difference? $121,638. Gone. Vanished. Transferred from your pocket to theirs. And here's the kicker. You did all the work. You saved the money. You took all the risk. The market did the heavy lifting. They just skimmed off the top. For what? For beating the market? Let me tell you about beating the market. In any given year, about 60% of professional fund managers fail to beat their benchmark index. Over 10 years, that number jumps to 85%. Over 20 years, nearly 95% fail. 95%. Think about that. You're paying someone 2% per year, and they have a 95% chance of losing to a strategy that costs 0.05% and requires zero skill. It's not a service. It's a scam dressed up in a three-piece suit. But wait, it gets worse. Because those numbers I just showed you, those assume your fund manager charges exactly 2%. Many charge more, much more. Some hedge funds charge 2 and 20, that's 2% of assets and 20% of profits. Some private equity funds take even more. And what do you get for all that money? Complexity, jargon, quarterly reports filled with charts you don't understand, phone calls telling you they're repositioning for the current environment. Translation, they're guessing, just like everyone else. The financial industry has built a cathedral of complexity to hide one simple truth. They can't predict the future. Nobody can. Not your advisor, not the guy on CNBC, not the hedge fund manager with a private jet. The market is smarter than all of them combined. But here's what really makes me angry. They know this. They've always known this. Study after study proves it. The data is overwhelming. Passive investing beats active investing over the long term. It's not even close. Yet they keep selling you the dream that they're special, that they've cracked the code, that they can see what others can't. Why? Because the truth doesn't pay their mortgage. Let me tell you what happened when I launched the first index fund in 1975. I stood in front of Wall Street and said, stop trying to beat the market, just own the whole market, keep costs low, stay the course. They erupted. They called it Bogle's folly. They said investors deserve better than average returns. One fund executive told me I was destined to fail because mediocrity can never be excellent. You know what I said? I'm not selling mediocrity. I'm selling certainty. The certainty that you'll capture the market's return, the certainty that costs won't destroy your wealth, the certainty that you won't get fleeced by someone in a suit who can't deliver what he promises. They hated that because it was true. And you want to know the real reason they hated it? Because an index fund doesn't need salesmen. It doesn't need expensive analysts. It doesn't need trading desks or research departments or quarterly strategy meetings. It just needs math. Buy everything. Hold everything. Costs go down. Returns go up. Simple. So simple that it threatens $1 trillion industry built on making simple things complicated. Now, I know what you're thinking, but Jack, my advisor, is different. He really cares about me. He's not like those Wall Street guys. Maybe he's a good person. Maybe he really does care. But here's the question you need to ask. Is he worth $121,638 of your retirement? Because that's what he's costing you. I'm not saying he's evil. I'm saying the system is rigged. Even good people operating inside a bad system produce bad outcomes. And the system is designed to extract wealth from you and transfer it to them. That's not my opinion. That's mathematics. Every dollar they take is a dollar you don't have. Every percent they charge compounds against you. Every trade they make generates friction that erodes your returns. Death by 1,000 cuts. You don't feel it happening. That's the genius of it. The fees are hidden in the fine print. The costs are baked into the fund. The damage happens slowly, silently, invisibly, until one day you're 65 years old and you realize your retirement isn't what it should be. And by then, it's too late. So what do? First, you need to understand the enemy. The enemy isn't volatility. It's not bear markets or recessions or corrections. The enemy is cost. Cost is the only thing you can control. You can't control returns. You can't control the market, but you can control what you pay. And here's the beautiful part. The less you pay, the more you keep. It's that simple. So go pull out your retirement statements right now. Find the expense ratio. That's the annual fee your fund charges. If it's above 0.2%, you're being robbed. If it's above 0.5%, you're being mugged. If it's above 1%, you're funding someone else's retirement instead of your own. I'm going to show you exactly how to stop it. But first, you need to understand why the professionals keep failing. Here's why the professionals keep failing. They're playing a loser's game. You know what a loser's game is? It's a game where the winner is determined not by who plays the best, but by who makes the fewest mistakes. Tennis is a perfect example. In amateur tennis, the winner isn't the person who hits the most amazing shots. It's the person who hits the ball back one more time than their opponent. You win by not losing. Investing is the same game, but Wall Street doesn't want you to know that. They want you to believe it's a winner's game. That skill matters. That intelligence matters. That their Ivy League education and fancy computer models give them an edge. It's a lie. The stock market is a zero-sum game before costs. For every winner, there's a loser. For every fund manager who beats the market, another one falls short. That's just math. But here's the brutal part. After costs, it becomes a negative-sum game. The croupier always takes his cut. And who's the croupier? The brokers, the fund companies, the advisors, the trading platforms. Everyone who handles your money is on their way to being actually invested. They all get paid, win or lose, up market or down market. Whether they beat the benchmark or lag it by 10 points, they get paid. So when your fund manager says he beat the market by 2% before fees, what he's really saying is, I did exactly what the market did, then I took your money. And you're supposed to thank him for it. Here's the number that should keep you up at night. In 2023, after fees, the average actively managed fund underperformed the S&P 500 by 1.4%. Not by a little, by a lot. And that's just 1 year. String together 20 years of that, and the gap becomes a canyon filled with your money, but they've got an excuse ready. They always do. It was a tough year for active managers. The market was unusually concentrated. Our strategy works better in volatile environments. Translation, we guessed wrong, but we're keeping your money anyway. You want to know the real reason they can't beat the market? because they are the market. Think about it. If you add up all the professional investors, the mutual funds, the hedge funds, the pension funds, the institutional money, they collectively own most of the market. So by definition, their average return must equal the market return. Before costs, after costs, they must underperform. It's not a theory, it's arithmetic. The only question is by how much? And the answer is by exactly the amount they charge you. This is what I call the relentless rules of humble arithmetic. The market returns what the market returns. Nobody can change that. But costs come right off the top. If the market returns 7%, you pay 2% in fees, you get 5%. If your neighbor pays 0.05% in fees, he gets 6.95%. Same market, same risk, different outcome. Over 30 years, that 1.95% difference turns into hundreds of thousands of dollars. Your money in someone else's pocket for doing less than nothing. Because here's the dirty secret. All that trading, all that active management, all those sophisticated strategies, they don't add value. They subtract it. Every trade costs money. The bid-ask spread, the commission, the market impact, the tax consequences. The more they trade, the more they cost you. And boy, do they love to trade. The average mutual fund has a turnover rate of 63% per year. That means they're selling and replacing nearly 2/3 of their holdings every single year. Why? Because doing something feels better than doing nothing. Because clients expect activity. Because that's how they justify their fees. But activity is the enemy of return. I learned this lesson 50 years ago, and it's never stopped being true. Don't just do something, stand there. The stock market is not a casino where you need to place bets every day to stay in the game. It's an ownership stake in the productive capacity of the American economy. You don't need to trade it. You need to own it. All of it. The whole haystack. That's the index fund. That's the solution. But let me tell you, when I first proposed this idea, they thought I was insane. I'll never forget the meeting. It was 1975. I was pitching the board of directors at Vanguard on this crazy idea, a mutual fund that would simply buy every stock in the S&P 500 and hold them forever. No stock picking, no market timing, no brilliant insights, just buy everything and sit tight. One director looked at me and said, "Jack, who would want to invest in a fund that's guaranteed to be mediocre?" I said, anyone smart enough to realize that mediocre is better than losing. And here's what the data shows. Over the past 30 years, only 12% of actively managed funds have survived and beaten their benchmark. 12%. That means if you picked an active fund 30 years ago, you had an 88% chance of either watching it disappear or watching it underperform. Those aren't odds. That's a massacre. But the index fund, it's still here, still delivering the market's return, still keeping costs low, still doing exactly what it promised. No surprises, no gimmicks, no broken promises. Just the market return minus almost nothing. And that almost nothing makes all the difference. Let me give you a real example. A real person, her name was Grace. She came to one of my talks in 1982. She was 35 years old, a school teacher, making $32,000 a year. She walked up to me after and said, "Mr. Bogle, I've been investing in these funds. My broker recommended. The fees are around 1.8%. Is that okay?" I did the math in my head. 30 years until retirement. Let's say she saves $5,000 a year. With 1.8% fees, she'd have about $430,000 at retirement. With 0.05% fees in an index fund, she'd have about $575,000, a difference of $145,000. I looked at her and said, "Grace, that 1.8% fee is going to cost you a year and a half of your salary every single year." For 30 years, her face went pale. She switched to index funds the next week. I got a letter from her in 2012, right before I had my heart transplant. She was retiring. Her portfolio was worth $612,000. She wrote, "Jack, you gave me an extra $180,000 for retirement. That's 6 years of teaching salary. You gave me 6 extra years of financial freedom. Thank you." That letter is framed in my office because that's what this is really about. Not beating the market, not getting rich quickly, not impressing your friends with your stock picks. It's about keeping what's yours. It's about not letting the financial industry steal your future 1 percentage point at a time. Grace understood something that most people never figure out. The market will give you its return. You don't have to be smart. You don't have to be lucky. You just have to show up and stay in your seat. The only thing standing between you and the market's return is cost. Cut the cost, keep the return. It's the simplest formula in finance, and it's the one Wall Street hopes you never learn. Because once you learn it, you don't need them anymore. You don't need the advisor with the leather chairs and the mahogany desk. You don't need the fund manager with the proprietary algorithm. You don't need the newsletter writer with the secret stock picks. You need a brokerage account and 3 index funds. That's it. Total stock market, total international, total bond market. Done. Set it, forget it, let compounding do its magic. But they can't make money off that, so they complicate it. They add layers. They create products with fancy names and complex strategies, and every layer costs you money. I've seen it 1,000 times. Someone comes to me with a portfolio that looks like a Christmas tree, 15 different funds, each with its own fee structure, each with its own strategy, each supposedly filling some critical gap in their allocation. I ask them, what's your total expense ratio? They don't know. I add it up, usually between 1.5% and 2.5%. Then I ask, what would happen if you sold all of this and bought 3 index funds? They look confused. But wouldn't I be less diversified? No, you'd be more diversified. Because those 15 funds are probably all holding the same stocks anyway, just with different weights and different fees. The complexity isn't helping you, it's hiding the cost. And the cost is killing you. Now let me show you exactly what that cost looks like in your retirement. Let's talk about what cost really means to your retirement. Not in theory, in your life. You're 50 years old, you've got $300,000 saved, you're putting away $15,000 a year, you've got 15 years until retirement. Scenario 1, you pay 1.5% in fees. Your advisor says that's competitive, that it's worth it for the expertise. At retirement, you'll have $776,000. Scenario 2, you pay 0.05% in an index fund, no advisor, no expertise, just the market. At retirement, you'll have $934,000. The difference? $158,000. That's not a rounding error. That's 3 years of retirement spending. That's the difference between retiring at 65 and retiring at 62. That's the difference between worry and peace. And what did you get for that $158,000? Nothing. Worse than nothing. Because studies show that advised portfolios don't just cost more, they often perform worse even before fees. Because advisors trade too much, because they chase performance, because they react to fear and greed just like everyone else. They're human, they make mistakes, but you pay for those mistakes. Here's what really gets me. The industry knows this. They've known it for decades. There's a reason Warren Buffett's advice for his wife's inheritance is to put 90% in an S&P 500 index fund and 10% in short-term bonds. Not because he's unsophisticated, because he's smart enough to know that simple beats complicated. There's a reason that when hedge fund manager Ted Seides bet me that hedge funds would beat index funds over 10 years, he lost badly. The index fund returns 7.1% per year. His hand-picked hedge funds, 2.2%. And these weren't random hedge funds. These were funds that Seides himself selected, the best of the best, in his judgment. They got destroyed by doing nothing. That bet proved something I've been saying for 40 years. The more complex the strategy, the worse the outcome. Why? Because complexity creates costs, and costs destroy returns. It's that simple. But the industry keeps selling complexity because that's where the profit is. They can't make money selling you simplicity. They can't charge 1.5% for buying 3 index funds and never touching them. So they invent problems that don't exist and sell you solutions you don't need. You need international exposure. You've got it in a total world index. You need a small cap value tilt. You've got it in a total market index. You need alternative assets for downside protection. You've got bonds. Every need they invent comes with a fee. And every fee comes out of your pocket. I call it the investor's dilemma. The more help you get, the worse you do. The solution? Stop asking for help. Buy the haystack, not the needle. Everyone's out there trying to find the needle, the next Apple, the next Amazon, the hot sector, the winning strategy. It's exhausting, and it's expensive, and it doesn't work. You know what works? Buying the whole haystack, every stock, every sector, every industry, all at once for almost nothing. Then you're guaranteed to own the winners, because you own everything. Sure, you'll own the losers too, but here's the secret. The winners outweigh the losers by so much that it doesn't matter. Over the past century, the U.S. stock market has returned about 10% per year. That includes the Great Depression, 2 world wars, the dot-com crash, the financial crisis, COVID. Through all of it, the market delivered, not because stock pickers were brilliant, but because American capitalism is productive. Companies make things, they sell things, they earn profits, they pay dividends, they grow. And when you own the whole market, you own all of that growth. You don't have to guess which companies will win. You know that some will, and you'll own them. That's not mediocrity. That's certainty. But the industry doesn't want you to have certainty. They want you to have hope, hope that they'll pick the winners, hope that they'll time the market, hope that this year will be different. Hope is expensive. Certainty is cheap. I'll take cheap certainty over expensive hope every single time. Now, let me tell you the 3 rules that will save your retirement. Rule number 1, own the market. Don't try to beat it. Buy a total stock market index fund. It owns every publicly traded company in America, about 3,600 stocks, 1 purchase, you're done. You now own a piece of every successful business in the country. Apple, Microsoft, Exxon, Johnson & Johnson, Tesla, all of them. When they succeed, you succeed. Automatically. Cost about 0.03% per year. That's $3 for every $10,000 you invest per year. Can your advisor beat that? No. Can your mutual fund beat that? No. Nobody can, because nobody works for free except the market. Rule number 2, stay the course. Don't react to noise. The market will go down, I promise you. It will drop 10%, it will drop 20%, maybe more. When it does, the experts will panic. The headlines will scream. Your neighbor will tell you he got out just in time. Ignore all of it. The market always recovers. Always. Every single time in history. The people who lose money aren't the ones who stay invested through the crashes. They're the ones who sell at the bottom and miss the recovery. Timing the market is impossible. I've never met anyone who could do it consistently. Not once. You know what's easy? Ignoring the market. Don't check your balance every day. Don't watch CNBC. Don't read the panic articles. Just stay in your seat. Rule number 3, minimize costs. Every percent matters. This is the rule that saves you $158,000. This is the rule that turns a comfortable retirement into a wealthy one. Look at every fee. Question every expense. If someone's charging you more than 0.2% for a basic index fund, find someone cheaper, because that extra cost isn't buying you anything except a smaller retirement. I've spent 50 years studying this. I've looked at every strategy, every approach, every gimmick, and I keep coming back to the same conclusion: low cost, broad diversification, long-term discipline. That's it. That's the entire secret. Everything else is noise designed to separate you from your money. But here's the hardest part: actually doing it. Because simple doesn't feel smart. Buying 3 index funds and never touching them doesn't feel like you're actively building wealth. It feels passive, it feels lazy, it feels like you're not trying hard enough. That's your brain lying to you. Your brain wants activity, it wants control, it wants to feel like you're doing something. But in investing, doing something is usually the wrong move. The best investors I've ever met are the boring ones, the ones who set up their portfolio in 1980 and never changed it, the ones who ignored every crash, every boom, every trend. The ones who did nothing, they're millionaires now. Not because they were brilliant, because they were disciplined. They understood something that most people never learn. Investing isn't about what you do, it's about what you don't do. Don't chase performance, Don't try to time the market. Don't pay high fees. Don't panic. Just buy, hold, ignore. Boring beats exciting every single time. I know this because I've watched it happen for half a century. I've seen the hotshot fund managers come and go. I've seen the revolutionary strategies appear and disappear. I've seen 1,000 different ways to supposedly beat the market. None of them works. Not over time. Not after cost. But the index fund, still here. Still working. Still delivering. It's the financial equivalent of water and exercise. Unsexy, obvious, effective. The question is, are you disciplined enough to do the boring thing? Because that's what separates the wealthy from the wishful. The wealthy do the boring thing consistently. The wishful keep searching for the exciting thing that will make them rich quickly. And while they're searching, they're paying fees. They're making mistakes. They're falling behind. Meanwhile, the boring investor is getting richer. Quietly, steadily, inevitably. Which one do you want to be? I'm going to tell you exactly how to build a portfolio that makes you immune to Wall Street's scam. But first, you need to understand the one force that makes all of this possible. That force is compounding. Einstein supposedly called it the eighth wonder of the world. I don't know if he actually said that, but he should have, because compounding is the only free lunch in investing. It's the reason a school teacher can retire a millionaire. It's the reason time matters more than timing. It's the reason starting early beats starting smart. But here's what nobody tells you. Compounding works both ways. It compounds your returns, and it compounds your costs. Let me show you what I mean. You invest $10,000. The market returns 7% per year. After 30 years, you have $76,123. That's compounding working for you. Now, let's say you pay 2% in fees. That same $10,000 grows to $43,219. The difference? $32,904. That's compounding working against you. You didn't just lose 2% per year, you lost 43% of your ending wealth. Because costs compound just like returns. They take a little bit every year, and that little bit grows into a massive amount over time. I call this the tyranny of compounding costs, and it's the silent wealth killer. You don't see it happening. The statements don't say we stole $900 from you this year. They're much sneakier than that. They just show you a balance and a footnote about fees somewhere on page 14 in 6-point font. By the time you realize what happened, you're 65 years old and you're short $150,000. And the advisor who took it, he's retired. On your money. This makes me furious. Not sad, not disappointed, furious. Because it's theft dressed up as service. They're not helping you, they're helping themselves. To your retirement. And the regulators, they allow it. Because the industry is powerful. Because the lobbyists are everywhere. Because the politicians need campaign donations. So nothing changes, which means you have to change. You have to take control. You have to educate yourself. You have to stop trusting people whose incentives don't align with yours. Your advisor gets paid whether you make money or not. The fund company gets paid whether the fund goes up or down. The broker gets paid every time you trade. Their incentive is activity. Your incentive is results. Those are not the same thing. In fact, they're opposites. The more they do, the more they make. The more they do, the less you make. So what do? How do you escape the scam? You fire them. All of them. You don't need an advisor to buy an index fund. You don't need a fund manager to own the market. You don't need a broker to hold stocks. You need a brokerage account and 30 minutes. Here's the portfolio that beats 88% of professionals. Ready? 60% total U.S. stock market index fund. 30% total international stock market index fund. 10% total bond market index fund. Done. Total cost? About 0.08% per year. That's $8 per 10,000 invested per year. Your advisor charging 1,5%? That's $150 per 10,000 per year. You just saved $142 times every 10,000 you have every single year forever. That $142 compounds. Over 20 years, it becomes $5,800. Over 30 years, it has become $13,400. Per $10,000 invested, if you've got $300,000 in your retirement account, you just saved yourself over $400,000 over 30 years. By spending 30 minutes to buy 3 index funds, that's the entire secret. That's the magic formula Wall Street doesn't want you to know. But I'm not done yet, because there's one more piece of this that will make you even angrier. Target date funds. These are the funds your 401 probably defaulted you into. They're supposed to be simple and automatic. They adjust your allocation as you get older, getting more conservative as you approach retirement. Sounds great, right? Here's the problem. They charge you for that service. The average target date fund charges 0.5% to 0.8% per year. For what? For doing something you could do yourself in 5 minutes once a year. Rebalancing. That's it. That's the entire value they provide. And they charge you 50 to 80 basis points for it. Over 30 years, that extra 0.5% costs you about $35,000 on a $300,000 portfolio. $35,000 for clicking a few buttons once a year. You could hire someone to do that for you for $100. Instead, you're paying $35,000. Does that make sense to you? Because it doesn't make sense to me. But here's what really makes me angry. They market these funds as simple solutions for unsophisticated investors. Translation: you're too dumb to manage your own money, so let us charge you for doing basically nothing. It's condescending. And it's expensive. You're not too dumb, you're just uninformed. There's a difference. And now you're informed. So what do you do instead? You build the same portfolio using low-cost index funds. Then once a year, you spend 5 minutes rebalancing it back to your target allocation. That's it. You just saved yourself $35,000. You're welcome. But I know what you're thinking. Jack, what if I need help? What if I have questions? What if I'm scared to do this on my own? Fair question. Here's my answer. Get educated, not advised. Read a book. Watch a video. Join a forum. Learn the basics. It's not complicated. There are only a few things you need to understand. Asset allocation, diversification, rebalancing, tax efficiency, dollar cost averaging. That's it. 5 concepts. You can learn them in a weekend. And once you understand them, you don't need to pay someone 1.5% per year to make decisions for you. You can make them yourself. But what about emotional support, you ask? What about having someone to talk me off the ledge during a crash? Here's my emotional support. If you look at the chart, every crash in history has been followed by a recovery. Every single one. 1987, 2000, 2008, 2020, the market dropped, then it recovered, then it went higher. That's not a prediction. That's history. And unless you believe American capitalism is dead, you should expect it to happen again. So when the next crash comes, and it will come, you don't need a hand to hold, you need a spine to stiffen. The market will recover. It always does. Your job is to be there when it happens, not on the sidelines, not in cash, not in some defensive strategy your advisor sold you. In the market, fully invested, riding it out. That's how you get wealthy, by being brave when everyone else is scared. And you know what makes it easier to be brave? Knowing you're not being robbed. Knowing that your costs are 0.08% instead of 1.5%. Knowing that you're keeping 95% of the market's return instead of giving it away to fees. That knowledge gives you confidence. And confidence lets you stay the course. This is what I've been trying to tell people for 50 years. The biggest risk in investing isn't market risk, it's behavior risk. The risk that you'll panic and sell at the bottom, the risk that you'll chase performance and buy at the top, the risk that you'll get bored and start trading. Low costs don't just save you money, they save you from yourself. Because when you're paying 0.08%, you don't need to beat the market to succeed, you just need to match it. And matching the market is easy, you buy it and hold it. No stress, no anxiety, no second guessing, just patience. When you're paying 1.5%, you need to beat the market by 1.5% just to break even. Every year. Forever. That's hard. That creates pressure. That makes you do stupid things. Like chasing hot funds. Like timing the market. Like trading too much. And every stupid thing you do costs you money. So the high fees don't just take your money directly, they cause behavior that takes even more money indirectly. It's a double whammy. Low costs protect you from both, they preserve your returns, and they calm your behavior. That's the real value of indexing. Not just the low fees, but the peace of mind that comes from knowing you're doing the smart thing. And here's what I've learned after watching investors for half a century. Peace of mind is priceless. The wealthy investor isn't the one with the biggest portfolio, it's the one who sleeps well at night. The one who doesn't check his balance every day. The one who doesn't panic during crashes. The one who doesn't spend his retirement worrying about money. That's wealth. Real wealth. And you can't buy it with expensive funds and complex strategies. You earn it with simplicity and discipline. Now let me show you exactly how to set this up so you never have to think about it again. Here's how you set it up. Step 1. Open a brokerage account at Vanguard, Fidelity, or Schwab. Takes 10 minutes. They'll ask for your social security number, bank account information, and how much you want to transfer. That's it. No sales pitch, no advisor meeting, no complicated paperwork. Just an account. Free to open, free to maintain. Step 2, transfer your money. If it's in a 401 con, you can't move it while you're still working at that company. But the day you leave, roll it over to an IRA at one of those 3 brokerages. If it's already in an IRA or a taxable account, initiate a transfer. They'll handle the paperwork. Usually takes a week. Step 3, buy your 3 funds. At Vanguard, VTI, VXUS, BND, Total Stock Market, Total International, Total Bond. At Fidelity, FSCAX, FTIHX, FXNAX, same thing, different ticker symbols. At Schwab, SWTSX, SWISX, SWAGX, same thing again. Doesn't matter which brokerage you pick, they're all good. The funds are basically identical. What matters is that you buy them and leave them alone. 60% of U.S. stocks, 30% international stocks, 10% bonds. Or if you're younger and can handle more risk, 70% U.S., 20% international, 10% bonds. Or if you're older and want more stability, 50% U.S., 20% international, 30% bonds. The exact allocation doesn't matter as much as you think. What matters is picking something reasonable and sticking with it. Step 4, set up automatic investments. Every paycheck, have money automatically deposited into your account and automatically invested in those 3 funds. You never see it. You never touch it. You never have to think about it. It just happens. This is called dollar cost averaging. You're buying a little bit every month, regardless of whether the market is up or down. When the market's high, you buy fewer shares. When it's low, you buy more shares. Over time, this smooths out your purchase price and removes all emotion from the equation. You're not trying to time the market. You're not waiting for the right moment. You're just systematically building wealth. Step 5, once a year, rebalance. If your U.S. stocks have grown to 70% of your portfolio and your international stocks have shrunk to 20%, sell a little U.S. and buy a little international to get back to 60, 30, 10. That's it. Takes 5 minutes. Once a year. This forces you to sell high and buy low. Automatically. It's the only market timing that actually works. And it's not even really timing, it's just maintenance. Step 6, ignore everything else. Don't read the market predictions. Don't listen to the stock tips. Don't watch the financial news. None of it matters. None of it will help you. It will only tempt you to do something stupid. And remember, in investing, doing nothing is usually the smartest move. That's the entire system. 6 steps, 30 minutes to set up, 5 minutes per year to maintain. And it will beat 88% of professional investors over the next 30 years. Not because you're smart, because you're disciplined. Not because you have some edge, because you're not paying someone to pretend they have an edge. This is the portfolio I set up for my kids. This is what I've been telling people to do since 1975. And it works. It always has. It always will. As long as capitalism works, this works. But I know some of you are still skeptical. You're thinking there has to be more to it than this. It can't be this simple. It is this simple. The complexity is a smokescreen. It's designed to confuse you, to make you think you need experts. You don't. You need 3 funds and discipline. That's it. But let me address the objections I hear most often. What about international diversification? You've got it. 30% of your portfolio is international stocks. What about small cap exposure? You've got it. The total market fund includes small cap stocks. What about bonds for safety? You've got them. 10 to 30%, depending on your age. What about alternatives? Real estate, commodities? You don't need them. They add complexity and cost without adding returns. What about picking individual stocks? Don't. You'll lose. The odds are overwhelmingly against you. What about crypto? It's speculation, not investing. If you want to gamble, go to Vegas. At least you'll get free drinks. Every question, every objection, every what about, they all have the same answer. You don't need it. More is not better. More is just more expensive. Simple beats complex. Every time. Now let me tell you what happens when you follow this approach. You'll feel stupid at first, because everyone around you will be talking about their stock picks and their fund returns and their strategy, and you'll have nothing to say, because your strategy is to do nothing. That will feel wrong, especially when their picks are working and the market's going up, but then the market will turn and their picks will blow up and their funds will underperform and their strategy will fall apart. And you'll still be sitting there doing nothing, owning everything, and slowly, quietly, you'll pull ahead. Not because you were smarter, because you were more disciplined. 5 years from now, you'll have more money than they. 10 years from now, significantly more. 20 years from now, it won't even be close. And they'll ask you, what's your secret? And you'll say, I did nothing. And they won't believe you, because people don't want to believe that doing nothing works better than doing something. But it does. This is the lesson I've been trying to teach for half a century. Investing isn't about action. It's about patience. It's not about intelligence. It's about discipline. It's not about beating the market. It's about not beating yourself. And the best way to not beat yourself is to tie your hands. Buy the index, set it, forget it. Let time do the work, because time is the only free lunch in investing. The longer you stay invested, the more certain your success becomes. Over 1 year, the stock market is unpredictable. It could be up 30%, it could be down 30%. Over 10 years, it's pretty reliable. It averages around 10% per year. Over 30 years, it's nearly guaranteed. There has never been a 30-year period where stocks lost money. Never. So your job isn't to predict what happens next year. Your job is to be there for the next 30 years. And the only way to guarantee you'll be there is to avoid the mistakes that knock people out of the game. Panic selling, performance chasing, high fees, over-trading, complexity. The index fund protects you from all of it. It's not exciting. It's not sexy. It's not going to make you feel smart at cocktail parties. But it's going to make you wealthy. And at the end of your life, when you're looking at your retirement account, you're not going to care whether you felt smart along the way. You're going to care whether you have enough money to live with dignity and freedom. The index fund gives you that. The expensive advisor doesn't. It's that simple. Now, I'm going to tell you the hardest truth of all. Most people won't do this. They'll hear what I'm saying, they'll nod along, they'll agree that it makes sense, and then they'll do nothing. Or worse, they'll keep paying 1.5% because it feels safer to have someone managing their money. Even though the data shows that advisor will underperform, even though the math proves they're being robbed, they'll keep doing it. Because change is hard, because simple feels too easy, because their brother-in-law told them about this great fund he's in, and 20 years from now, they'll be the ones asking, why don't I have more money? And the answer will be because you paid someone to take it from you. Don't be that person. Be the person who sees the scam and walks away. Be the person who values evidence over emotion. Be the person who's disciplined enough to do the boring thing. That's how you win this game. Not by being the smartest, by being the most sensible, not by taking the most risk, by avoiding the most costs, not by doing more, by doing less. I'm 96 years old. I've spent 70 years in this industry. I've seen every strategy, every innovation, every revolution in finance. And I keep coming back to the same conclusion. Buy the haystack. Keep costs low. Stay the course. That's it. That's all you need. Everything else is noise designed to separate you from your money. So here's my challenge to you. Pull out your statements right now. Look at your expense ratios. Add them up. If they're above 0.2%, you're being robbed. And now you know exactly what to do about it. The question is, will you? Or will you keep funding someone else's retirement instead of your own? The choice is yours. But the math doesn't lie. Every day you wait is another day you're losing money. So don't wait. Do it today. Open the account. Buy the funds. Set it. Forget it. Your future self will thank you. Trust me. I've seen it happen 1,000 times. The people who listen to this advice become millionaires. The people who ignore it become cautionary tales. Which one will you be?